At Crown Point, we believe in creating a real estate experience for our clients that is second to none. Educating and preparing our clients for what to expect is the best way to ensure we get you started in the right direction. As committed realtors, we are always on the go and always well caffeinated. We decided why not answer your real estate questions over a cup of coffee at some of our favorite spots. This is Coffee with Crown Point.
Good morning. Welcome to Coffee with Crown Point. I'm Gidget, broker owner here at Crown Point Realty, and today we're going to be talking about the new tax law that went into effect, I believe, January 1st. And joining us today is Bruce Gardner, partner over at Swan Gardiner, a local CPA firm here in Nevada. Thank you, Bruce, for joining us.
Thank you. It's nice to be here.
So tax laws, not that much fun for all of us to talk about, but it does impact us. So Bruce, just in a broad sense, tell us what the tax laws mean for people looking to buy or sell real estate here in Nevada.
Okay. First of all, though, tax law is fun for me to talk about. There's two areas of change that's going to affect people who own real estate. Whether you live in Nevada or another state in the United States, it's still going to affect you. The first area of change is going to be the area of the deductibility of home mortgage interest. Under the old law, you could have a home mortgage loan up to $1 million, and you could have a second mortgage up to $100,000, and you could deduct the interest on those. If your mortgages exceeded those amounts, you would prorate the interest to pare it back so that you are only deducting the interest on that $1 million. The new law has changed so that that ceiling on the mortgage is going to be $750,000 of loan. And the deduction for second mortgages is going to be completely disallowed.
Okay. So that's going to be a big issue for our homeowners that are looking at refinancing or taking out a second for home improvements.
It will, because from now on, I think instead of taking out a second for home improvements, I think people are going to be more inclined to just refinancing. And so it's going to change that mortgage market. I think there's going to be a lot fewer second mortgages, and there's going to be a lot more refinancing of your house.
Well, I think that's something they'll probably have to sit down with their CPA or talk to a CPA about, because they'd have to weigh the advantages of the tax write-off or the higher interest rates, because many of our clients have gotten interest rates back when they were at 3.25, or 3.5. And if we're looking at interest rates possibly rising this year, that's going to be an interesting equation they'll have to look at.
Yeah, and people are going to have to look at the cost of refinancing. Sometimes refinancing your house is a little bit expensive. Could even be that you don't have enough equity in your house to actually refinance, so you have to have a second. And so I think people are going to have to be more careful about how they buy and how they finance houses.
So one of those things that a lot of our buyers look at are the conventional loans with the second down payment assistance or the 20% down loans. So even on those programs, the 20% down loan is going to be non-deductible.
It will be non-deductible, yes.
That's something to consider. So I know there's another big impact that could be beneficial to Nevada. So can you tell us about the tax deductions that are going to be limited?
Yeah, the new tax law has a limit of $10,000 for a tax deduction for a person. It doesn't apply to rental property. It only applies to your personal residence. And so the $10,000 deduction is really going to be a combination of sales tax, state income tax, and property tax. And so if you live in an area that has high tax rates in those areas, it's really going to hurt you on your tax return.
So that means those people that are looking at California right now, our neighboring state where we see the most of migration into Nevada, that's probably going to increase the number of people that are looking to move to Nevada or local states like us where we have no personal income tax and low property tax.
Yeah, it will. It'll affect people that live in California, New York. There's other states that actually have low income tax, but they have high property tax, and that's how they produce revenue. I have a client that owns property in Corpus Christi, Texas, and the property tax down there is really, really high because there's no state income tax.
So their limitation is going to be at the $10,000?
Yes, it will. Everybody's limitation will be $10,000, and so you get to use whatever of those taxes you want in whatever combination you can use, as long as you don't exceed the $10,000.
Okay, well, that's going to be interesting. We'll see what that means for 2018, but I think it's going to be good news for our sellers as we're going to see an influx of buyers coming in from those states here.
It will, because our property taxes in Nevada are relatively low compared to a lot of other states.
So there's one other deduction that's going to go away in 2018 that will affect our buyers. That is the moving tax, the loss of the moving.
Yeah, you don't get to have a moving expense deduction anymore. So when you move, that deduction is just simply gone. And so you'll be paying for the move on your own with no help from Uncle Sam.
Okay, well those are, some of that's some good news, some of it not so good, but is there anything else in regards to our general buyers and sellers that we should consider before we move on to our investor clients?
I think one important thing to remember with the new tax law is if you own property in a foreign country, you no longer get to deduct the property tax on that.
Oh, okay. So people that might have a second home in Baja, California, or those types of things, and they'll be limited on
Europe, Mexico, wherever they have a second home, they're not going to be able to deduct the property tax on that because it's property tax on a foreign property.
that. Okay.
If it's, again though, if it's a rental property, the rules don't change. If you have a rental property, you still get to deduct the entire property tax on it. It's still subject to all of the passive activity loss limitation rules that have been in effect for a number of years. So it does affect your personal residence, but it doesn't affect your rental properties.
Okay. What about the deduction, or I should say the benefit of being able to keep your primary residence on a gain? So previously, I believe the limit was $500,000.
That law didn't change.
Okay, so
They were talking about it, but it didn't make it into the final draft.
can you just tell us, touch base again, tell us what that law is right now?
The law is if you have a personal residence, if you live in it any 2 out of the last 5 years, if you're married filing a joint return, you get a $500,000 exclusion. If you're single, you get a $250,000 exclusion.
Oh, okay, so those of you who might be looking at selling your property in California and moving here to Nevada, or some of those states where they have higher sales prices, they can still not pay tax on that gain up to $500,000.
As long as it's a personal residence. Yes.
Okay, perfect. Okay.
That law doesn't apply to rental property.
Talking about rental property, we have a lot of our clients that are investors. So what are some of the changes that have affected our investing clients that have investments in real estate properties?
This tax law really didn't change much at all for investments in real estate. You still get to deduct the mortgage on it, you still get to deduct the property tax on it. You treat it the same way that you've always been treating it. Nothing has really changed. Even the passive activity loss limitation rules are still the same.
And the ability to do a 1031 to...
There are some changes to the Code Section 1031 rules. You can only do 1031 exchanges now on real property.
Okay.
You used to be able to do it on personal property. You could do it on business vehicles and business equipment. And you can't do it on that anymore.
Oh, so now we're looking at some of the investors who might have looked into some other venues for 1031 exchanges, might be looking at moving some of their investment activity into real estate.
Real estate is becoming more attractive.
Yeah, certainly. Great. Well, I think that, is there anything else we need to know about in that tax bill? How many pages was it?
I think it was about 1,100.
1,100, and that's just the outline.
We'll see. But
Okay.
One interesting thing about the tax law, the new tax law, is it hasn't really been codified yet.
Codified.
Yeah,
What does that mean?
It's not part of the Internal Revenue Code yet.
Okay.
The IRS first takes a look at all of it, and they have to give their nod of approval or disapproval on each section of it, because they have to look at it and determine if it looks like it's going to be feasible to actually enact these laws. Sometimes Congress enacts laws that become very difficult to enforce, maybe even impossible to enforce, and so the IRS gives their opinion about the whole thing, and a lot of times when that happens we see little changes and tweaks to tax laws. So probably over the next few months we're going to see some changes to the law.
Well, I am very happy that Bruce read those 1,100 pages for me, and I did not have to read those, and I'm glad that you enjoyed it. Well, I just want to thank you again for joining us today. I know that this topic is, though many of us don't like to talk about taxes, but we are all starting getting ready to prepare for our 2017 tax return, that this is an important item that we need to know about, so we're making wise decisions. So thank you very much for coming today.
You're welcome. Thanks for having me.
And we look forward to talking to you next week at Coffee with Crown Point.
Do you have a question that you'd like to have answered? Feel free to submit a comment below, send us a message, or give us a call, and we will feature it in an upcoming episode.